All right, welcome to the midweek update. My name is Patrick Dunuwila. I'm a technical analyst and editor of the Chart Report. Joining us today is Steve Strazza of All Star Charts. Prior to working at All Star Charts, Steve actually helped me launch the Chart Report. So we worked closely together for about 2 years, and we continue to talk on a daily basis. We don't always agree, but when we don't, those are some of the best debates I have with markets people. So without further ado, Steve, how are you today?
I'm great. And you're right. So this should be fun. Hopefully we have some stuff to disagree about today.
Well, so I just got done reading your latest RPP report, which is kind of your weekly State of the Union on the markets, right? Is that how you would describe it?
Definitely. Yeah, we try and cover everything.
Yeah, and you have some really interesting topics in there, and I just kind of wanted to, dig deeper on a few of them and see if you could kind of shed more light on them. You start off the note by talking about how we're in this really messy market environment. And, that might be kind of hard for viewers to understand. You're calling this a messy market environment, but at the same time, Steve, the S&P 500 just logged its 50th all-time high for the year. So how do you kind of, make sense of those things? Because, if you're just looking at the S&P, it looks like things are as good as they get, right?
So are we talking to passive investors who are only invested in SPY and the Qs? Then yeah, the market's fine because being driven by mega cap growth. So if you actually look under the hood, breadth peaked back in Q1, Q2, depending on what metric you want to look at. And it's really been a sideways mess for the vast majority of stocks since you could say February, March, April, May. Transports peaked out in, I think, May. You saw a lot of cyclicals peak then too, but small caps and mid caps peaked much earlier. You can see in the first chart that we're showing here, this is the mid cap 400. When you go down the cap scale and you look at the Russell 2000 or the S&P 600 and small caps or micro caps, looks even worse, but we have gone straight sideways for the better part of the year.
I think we were talking earlier, it's basically the further down the cap scale you go, the worse and worse it looks, right? You start with large caps, those look great. The S&P, as we mentioned, looks great. But then you get down to micro caps and man, does it look bad.
The median drawdown, if you look at the components, the median drawdown for a lot of these indexes that are not S&P 500, and even the S&P 500's median drawdown would surprise some people. Majority of the stocks have already corrected. If you want to make a correction 10%, while the S&P keeps grinding higher, you look underneath the surface, median drawdown is more than 10% for all these indexes. And it gets worse as you go to the Russell 2000 and then on. So I guess the point there is everybody's saying there needs to be a correction, there needs to be a correction. Well, most stocks have already corrected beneath the surface. So after going sideways look at Apple, for example, it's gone sideways for 12 months. You could look at the mid caps right here in this chart. They've gone sideways since March, right?
Yeah.
So they've been correcting through time and price, depending on what you want to look at. So in my opinion, that's very normal for the second year of a cycle, especially after the gains off of last year's lows. I think this is a healthy digestive period.
And you've kind of been on that whole, year two of a new bull market kind of sees this sideways action. You guys have been pounding the table on that since maybe January or February of this year. So kudos there. But another big part that you talk about in the RPP report was about how we've gotten a lot of good resolution and a lot of information this week alone, right? It's only Wednesday, but starting Friday, really, the market ended last week. A lot of assets were testing key levels, and we kind of saw a lot of those reverse. We saw a lot of whipsaws, as you called them. I was wondering if you could kind of talk to some of those whipsaws, give viewers an idea of why we watch those moves. And yeah, you saw them in the dollar, crude oil, energy, copper, you name it. A lot of these broke a key level maybe Friday and then quickly reclaimed them. So how are you kind of thinking of those? What are some notable ones that you're watching?
Well, first of all, just to reiterate the messy market, theme that we've been harping on, and we wrote in a post yesterday, when we harp on a theme, our own behavior is information. If we find that, oh my gosh, we're being obnoxious about saying this is a mess, this is a mess, this is a mess, that's probably because it's a big mess and it's probably going to keep being a mess. And that's we've been saying this since early Q2 now, and we're still saying it. You can see the AD lines here. Depending on what you're talking about, large, mid, or small caps, you're talking about completely different markets, right? Let's move on and talk about whipsaws. When you're in a messy market that's completely full of indecisive price action, whipsaws happen all the time. Breakouts fail to the upside, breakouts fail to the downside. That is just like such a staple characteristic of a mixed market. That's exactly what we saw over the past 2 weeks. All over the place. You mentioned the dollar. The dollar broke out of its range, failed miserably, nasty shooting star candle, follow through into the beginning of this week. And that had a ripple effect throughout really any US dollar denominated assets, any cyclical assets, any commodity centric currencies or stocks. So this triple pane chart of commodities shows you that this was happening throughout the entire commodity complex. It's not just energy futures, it's not just base metals, and it's not just ags, it's everywhere. So you see soybeans, copper, crude oil, they're all back above those levels. This chart's about a day old.
Yeah, it seemed like a lot of those whipsaws that we saw this week were mostly kind of dollar sensitive assets, like your crude oils, like these commodities that you have here. And that failed breakdown in crude oil looks like it's kind of playing out in the energy sector as well. You look at XLE and it's, I'm not sure off the top of my head, but I'd guess that it's probably the best performing sector this week so far.
Just pulled that up. I mean, look at that. That's a little island reversal. It's one thing to have a whipsaw, right? A whipsaw doesn't have to happen at a key level of interest. When it does, pay attention even more. Whipsaw really just means something is moving fast in one direction and then just reverses on a dime. No bottoming process, no topping process, just that's a whipsaw.
And real quick, are you kind of using those terms synonymously, like whipsaw and failed breakdown?
A whipsaw is a very fast failed breakdown. So if you look at regional banks or something, they failed below our risk level and they hung out there for a few weeks and then recovered. Still a failed breakdown. You wouldn't call it a whipsaw too. What we're seeing in energy, it spent 1 day below our risk level. The same, it's from the June highs from last year and some key pivot lows from this year. We cut right beneath it, spent a day there, 2 days actually, and then gapped right back up higher. And from failed moves come fast moves.
It's almost like a little island reversal down there.
Sure, totally. And then, I mean, look at this. This is another oopsies in the Canadian dollar, US dollar. So you're seeing it in commodity-centric currencies too. It's all these cyclical assets.
You're not necessarily saying that XLE or energy is the sector to be in right now, but you're saying that there's information in the fact that it didn't die, right? I want to reiterate that. You're not saying that we should be, hunting for opportunities in XLE right now. You're more saying, pay attention to what that message is telling the broader market. Is that correct?
100%. Yeah, thanks for bringing me back there. If the bears can't take control of the weakest areas in the market, right? These are our laggards. Energy is and has been the laggard.
Longer term, yes. Yeah.
They had every chance to bury this thing. Can't do it. How is tech and healthcare and everything else that's performing well going to get hit if the bears can't take out the weakest areas? That's where the information lies. And you saw it in all the other weakest areas too. Airlines, I think we used this modern travel ETF because this is a good barometer for the reopening trade, right? These are just
I mean, we used that in chart of the day yesterday. I thought what you said there was so, and you just reiterated again, if the bears couldn't kill the worst stocks, how are they ever going to take control of the broader market? And I think that is the key message there. They've had every single chance to break this thing and they haven't. Right. So there's information in something that didn't happen, right?
And there's more information this week because I want to know, okay, we got the failed move and then we're getting this fast move. And now we're whipping it higher. How strong of a move, of an automatic reaction higher are we going to get from these sectors?
Yeah.
Keep ripping. Like, I want to see how these weekly candlesticks end up. That's going to be information too. Or does this fade and roll over again? Because we've been in this messy market where it's like the bears have control for 5 days. And it looks like going into last Friday's close, it looked like this could be it, right?
Yep.
Monday, Tuesday, it's a completely different story. Now it's the Bulls game to lose again. So
very choppy. You'll have value lead for a week or two, and then it's the total opposite. It's very, very. It's a absolute whipsaw. Whipsaw City.
We did a post on that. Whether it's growth value or whether you're looking for sector leadership these days, it's really just all these relative ratios are a mess. It's really hard to find like where's the alpha in the stock market. It's been tough to pinpoint that. There, of course, are always pockets of strength, but there hasn't been like this clear secular leader. Tech is not a secular leader anymore. It's gone sideways relative to the broader market for 12 months.
Which you could argue is healthy, right?
Yeah.
I mean, given where it came from, it zoomed off the March 2020 COVID lows.
Sure.
So this period of what has it been now? 6 months of just nowhere, sideways.
It's been at least 6 months. I think it's more. I'd have to look.
Yeah, so that's healthy. But the last thing I want to get to, the last thing that kind of caught my eye was you're talking about a potential reversal in Chinese equities, which have been absolutely battered. I saw a stat somewhere that in the last, 3 months, the drawdown in the China A shares has actually been worse than the drawdown for the A shares in the COVID sell-off. So the last 3 months for Chinese equities have been worse than COVID was for Chinese equities.
Yeah,
But you're saying that there might be an opportunity now. You're saying that we're starting to test a level on the relative basis. Why don't you talk to that?
I'm not saying go out and buy China, but China is.
You're not saying go catch a falling knife?
No.
You're not telling us to do that?
But think of China like you would think of the MAGA stocks, right? Microsoft, Apple, Google, Amazon, the $1 trillion club stocks, right, in America that drive all these indexes. They're the reason why the S&P and the Qs look the way it does. Well, the reason why emerging markets looks the way it does is because of China, and mostly Chinese tech. And this is all.
Yeah, I think in the note you mentioned that China is 40% of EEM. I mean, that's huge.
It's almost 40.
Wow.
It's down about 35 now because of all the selling pressure in China. But emerging markets are not going to start working while China is just getting crushed. For China to just bottom out and just carve out a tradable low and go sideways, that could just go miles for a lot of these diversified global indexes, not just emerging markets, but a lot of the other ones too, because China is just such a dominant player in a lot of these indexes. So what we've done in this chart is shown emerging markets without China, looks great, above our support level, and then emerging markets with China, which is the EEM that everybody's used to, it's trapped below those 2018 highs. If China can find its footing here, it's going to drive that higher, and that's going to be another one of these whipsaws and failed breakdowns that we're talking about. And that's a big one. If you could add that one to the list, that's going to have some serious implications.
Yeah, I think that's really interesting, especially in the context of the dollar too. You mentioned earlier the potential failed breakout in the dollar. So, if dollar does continue lower here, that should be really beneficial to emerging markets, right? And you also mentioned something really interesting the other day. You were saying, emerging markets doesn't need China to go up. It just needs it to stop going down. But if it does start going up, then it's off to the races for EEM, wouldn't you say?
That's not the bet that I'm making right now, right? Just to be clear, bottoming is a process. China's been hit hard. I would give it some time to go sideways before we see an actual trend reversal there. But yes, if China, enters a new uptrend phase here, emerging market breadth is actually very good, especially outside of Asia. Breadth in emerging markets is expanding. If China starts participating too, you're probably looking at an EEM that's back at all-time highs sooner rather than later. And this last chart is Chinese tech relative to the S&P. What better time than now? What better place than here for these, Chinese mega caps that drive emerging markets, which are most of the big cap tech names, Alibaba, Tencent, Meituan. I probably butchered that, but those are some of the biggest components along with Taiwan Semi, and they're right at the bottom of their range. If you could see a relative trend reversal here, that would go a long way too. I think that people shouldn't snooze on China. And the last thing I'll say is that sentiment is in the absolute dumps for China.
I absolutely love these magazine covers. You guys really pick on The Economist a lot.
No, I mean, it's right in our face. They back-to-back weeks, they have emerging markets a rainbow into a dumpster. And then the next week, there's somebody banging a hammer and stepping on Chinese tech names. So these magazine covers have worked for us in the past. Kind of just seems like everything's coming together for China to carve out a bottom here. and it's going to have major implications on risk assets, mostly international equities, obviously.
So don't rush out and try to catch that falling knife, but definitely keep an eye on it, and more importantly, keep an eye on what it means for emerging markets, right?
Yeah.
Really beaten down asset class, but a lot of investors have exposure to it.
And to bring it all back, Pat, this also speaks to like if bears can't take out the worst areas, right? And you're seeing like China's been the global laggard by far. China is energy around the world. That bottoms and scoops higher. It's like, what do the bears have left? They're running out of talking points. So, next few days are going to be interesting. Next few weeks are going to be interesting. We need to see follow through now on a lot of these failed moves, and that'll be our next major piece of information.
Yeah. Well, Steve, I think we've run out of time, but I appreciate you coming on, and we hope you we hope you come back on soon.
Always good chatting, buddy. Thanks for having me, Pat.
All right. Well, thank you for watching, and we will see you next week. Thanks.